Comments in this video, I'm discussing the accounting paper that came in 2024, latest for 2025 yellow students. So here I'm discussing all the questions starting from number 1 to 50 with all workings and explanations as well. So first three, they're asking from theoretical knowledge based on the introduction for accounting. So, which of the following statement best describe the primary purpose of financial accounting? Okay. So it specifically asks the primary purpose, and the answer you should go for the best answer, right? So reports pass financial information of the firm to satisfy statutory requirement. It is okay, but that's not the primary purpose. Reports a transaction of the firm to prepare the general purpose financial statements. Uh, you can consider that that is the answer as well, but let's see the others. Provides the specific financial information about the firm for the investors and lenders. Not only the specific financial information, we are not only providing information for investors and lenders in account. Prepares the general purpose financial statements of the firm based on accounting standard. It's a general term, but it's not the primary purpose. And the last answer provides the information for the decision making of the external stakeholders of the firm. So out of these five, the best answer, the primary purpose of financial accounting based on your syllabus and the teacher's guide, it should be number five, provides the information for the decision making of the external stakeholders of the firm. Second one, a firm is unable to continue its operations for foreseeable future, and which of the following accounting concepts are not relevant in the preparation of financial statement of these firms. So if a firm can't continue their operations for the foreseeable future, then you can't follow the going concern concept and historical cost concept. So answer should be third one, going concern and historical cost concept. In the third question, they're asking which of the following statements are correct as to the application of business entity concept. So in the business entity concept, generally saying that the business and the owners are two separated parties and you have to do accounts based on your from the point of view of the business, right? So the whole transaction of a business are recorded from the perspective of the business. That's correct. This concept provides the basis for identification of the reporting entity. That's also correct. And the owner's investment in the business is presented as a claim to the resources of the business. That's also correct. So the correct answer should be fifth one. All A, B, C statements are correct as per business entity concept. Okay. And these are my workbooks that I publish up to 2025 A levels. 5 practice papers and 25 company concoctions and 25 cash flow exercises. All these questions are discussing through YouTube videos like this. So you can purchase book from me. Just send me a WhatsApp message and do it yourself, correct yourself, and then you can go with that video and understand what's happened or what you lack of, right? So regarding this case study, you have to answer fourth question, fifth, sixth, and seventh, right? So as these questions, when they are given a question like this with a big case study, first of all, read the questions and then come back to the case study, right? Case study එක කියවලා question කියවලා වැඩක් නැහැ. It's a time waste. So first of all, look at the questions and then come to the case study. So in the fourth one, they are asking which of the following accounting equation reflects the net impact of only the transaction number 1 and 2. So the equation is given here, assets equals liabilities plus equity. So here the assets, here the liabilities and equity, and they are asking only the net impact of the transaction number 1 and 2. So first transaction, sold goods costing 240 to Amal for 354 on credit inclusive of 54 VAT. And here it's clearly saying this Chandra retail business is a VAT registered business. So if it is a VAT registered business, so which means you have to do VAT in a separate account, right? So as like these cases, the purchases, sales, return invoice and return also you should identify without VAT, and that VAT you should uh, do with a separate account, right? So here what happened, you are selling 240 worth of stock, so your assets getting decreased by 240 and you are selling that for 354 on credit. So which means your debtors increasing, which means your assets are increasing 354. And that includes 54 VAT. So these are the VAT that you collected from your sales. So which means your liabilities are increasing by 54. So after excluding the VAT, the selling price is here is 300. So what happening here? You are selling 240 worth of stock for 300. The net sales value net sales value after excluding VAT is 300. So from that you are getting the profit 60, and that profit you should add to the equity. And second one, it says received a check from Amal to settle the total due amount after allowing a cash discount. So that cash discount you should consider as your expense, and your total debtors are decreasing here. So after discount, you are getting 324 cash. So your assets are increasing 324. So after recording these first and second transactions, the net effect for the assets are increased by 84 and the liabilities increased by 54 and your equity is increasing by 30. So the correct answer should be number one. And for the fifth one, they're asking the source documents used to record the transaction number 3, 4, and 5 in the books of Chandra business, right? So the third transaction is sold goods costing 324, 472 for cash, right? So this is a cash receipt. So the source document of identifying the cash receipt is the receipt. Fourth transaction sold goods costing 400 to Bimal for 590 on credit. So here you are selling the stock on credit. So the credit sales source document is sales invoice. And then they are returning back to us. So returning back the source document, the credit sales returning back to the business, the source document is credit note. So the correct answer should be answer number 2. Now, sixth one, they ask me what is the correct double entry to post the total of sales journal of Chandra business for the month of Jan 2024 to its general ledger. So in the sales journal, you are only recording the credit sales, right? So here there are two credit sales. First thing to Amal and fourth one to Bimal. So the buyer's name are Amal and Bimal. And here the sales we have to record excluding VAT value and then VAT value and the total. These are workings, sir. You have to do this working to find out the totals. But if you have the sales journal in your mind, so you can do these workings through your calculator. I'm here just show it, right? Because always keep in mind you have to manage your time in first paper. රෝනට වඩා වෙලාව වාට නාස්ති කරන්න බෑ to do these types of workings as this life as this perfect. So if you have if you have the format in your mind, then do the calculation through your calculator and get the answer, right? So here the total debtors is 944. So always, if it is a VAT registered business, you have to record, which means you have to debit or credit to the debtors with VAT, the total value, right? And here you are collecting VAT from your credit sales, and that collected VAT you have to credit to your VAT account. And if it is a VAT registered business, always keep in mind all the sales and purchases you should identify identify is excluding VAT. So you are excluding VAT, net sales are 800. So sales should credit 800. So the correct answer should be third one for question number 6. The seventh one, they ask you the VAT control account balance, ignore VAT on purchase, and the debtors control account balance as per closing date of Chandra business. So here I drafted the VAT control account and debtors control account. And from the sales journal, the total sales and VAT you should debit to the debtors control account. And it says you are settling cash for the Mr. Amal 324. And that point you are getting a discount of 30. And then Bima return 100 uh, and the VAT of that is 18. So the balance carried down of the debtors control account should be 472. So in the VAT control account, the total VAT that included in credit sales is 144. And also here you have to add the VAT that you generated from cash sales as well. So in the second, yeah, no, in the third one, it says sold goods costing T20,000 for 472, including 72 VAT. And that's VAT. Also, you have to credit to the VAT control account. So here, this 144 is the VAT that you collected from credit sales. And here, the 72 VAT is that the VAT you collected from cash sales. And then afterwards, yeah, Mr. Bimal is returning back to you. So then you have to reverse the sales VAT as a return invert. Then you can get the VAT control account balance as 192. The correct answer for question number 7 is answer number 4. In 8 months, if the net profit as per the draft financial statement of a company for the year ending 31st March 2024 was rupees 5 million. So the draft profit here is 5 million. And then they are given three adjustments or errors, and then you have to rectify these errors and find out the correct errors, right? So your draft profit is 5 million, and the first thing it says the total of sales is 8,500, but it has been posted to the general ledger as 5,800. So you reported sales undervalue. So the difference of that you have to add to the profit, right? And here it says sales commission payable 450 had been debited to the sales account. So it should be debited to the sales commission account, but instead of that, they debited that to the sales account. Either way, you are the expense was recorded, which means when you are debiting to the sales account, so your sales was uh, decreased, right? So the effect of the expense is recorded anyways. So when you are correcting that, the double entry should be sales commission expense account debit and sales account credit. But it's not affecting to your profit. Okay. And the last one it says the bank loan installment 850 had been paid and it has been debited to the bank loan account, which means the full bank loan installment 850 you debited to the bank loan account. But what happened here, the interest was not recorded, right? So the interest you should record and interest is an expense. So when you're paying the bank loan installment, in the bank loan installment, it includes the bank loan plus interest. So the bank loan is a decreasement of a liability, but the interest payment is an expense for you, right? So recording loan interest from the draft of profit, you have to deduct that. Then you can find out the adjusted profit as 7,550. So the correct answer for question number 8 is answer number 3. And the 9th one is also error correction. So during the year ending 31st March 2024, the owner of the business obtained goods costings 56,000 as dollars. No adjustment for that. However, the closing inventory had been calculated based on the physical stock balance as in closing date. And the gross profit and the net profit of the business is given as 250 and 120, right? So in these cases, you have to keep in mind that any change that you are doing in gross profit or any error correction that affect into your gross profit is also affecting to the net profit as well. Because you are finding the net profit after your gross profit, right? So any adjustment that you are doing in the gross profit, which means in the trading account, it is also affecting to the net profit as well. But the other incomes and expenses that you are recording net profit is not affecting to the gross profit, right? So here, the thing that they didn't record is what? Stock drawings. So simply stock drawings is not an expense. But the double entry of stock drawings is uh, drawings debit and cost of sales credit. So cost of sales is your main expense. So when the owner withdraws stores, then it should deduct from the purchases as stock drawings. So which means your cost of sales should reduce, and from that, then your profit should increase, right? And the gross profit should increase by 56. And based on that thing, anything that affect into the gross profit is also simply affect into the net profit as well. So your net profit is also should increase by 56. So your adjusted gross profit and adjusted net profit are 306 and 176. Okay. In the 10th one, they are saying the information given below relates to the trade debtors of Farley Enterprises, the sole trader. The credit balance of allowance of for doubtful debts as in opening date is 70,000. Trade debtors as in closing date before adjusting bad and doubtful debts was 1,050. So your closing balance of the debtors before adjusting bad debts and doubtful debts is 1,050. From the 1,050, it says 50,000 receivables from the trade debtor as in closing date had to return off as bad debts. So it should deduct from the debtor's balance. And now your adjusted balance as per closing date is 1,000. And from this 1,000, you have to minus the doubtful debt portion, then you are getting the carrying amount of the debtors. So carrying amount, which means the carrying amount? Carrying amount means the debtors net balance that you should mention in your SOFP. So when you're mentioning debtors in your SOFP, it should deduct the provision for doubtful debts as well, right? So the carrying amount of the debtors is 960. And then they are asking the bad and doubtful debt expense together, right? So I am getting the answer. I got the answer from the account, right? So here the bad debts and provision for doubtful debts. The opening doubtful debt provision is 70, and the closing doubtful debt provision is 40. And the bad debts happen. So the double entry of bad debts is bad debts to expense account debit and debtors credit. So altogether, the bad debts and provision for doubtful debts total expense that you should mention in your income statement is 20. So how you get that actually? The bad debts 50 is straight away is an expense, and then there is a over provision that comparing to the last year, because the last year's doubtful debt provision is 70 and the current year doubtful debt provision is 40. So comparing this year to the last year, it's a over provision that happened in the last year. So when you're adjusting that over provision, what you should do, that over provision you should minus from the distribution expenses, right? So the total bad debts is 50, and there is over provision that came from the last year 30. So the net expenses of bad and doubtful debts is 20. In the 11th and 12th question, they are asking from the case study, they are asking the total manufacturing cost and the cost of sales, right? Here, the following balances have been extracted from the accounting records of Mihirani Enterprises, a manufacturing business. So here I drafted the production cost, which means the manufacturing account, right? So it's starting from opening raw materials. So opening raw materials given here 45 and 60 and 45. Here, these are the opening balances, sir. These are the closing balances. Patlagani power. Right? And the cash payment made during the year is given here as well. And the additional information it says all raw material purchases are made on credit basis. So you have the trade creditors opening and closing balance, and you have the cash payment to your trade creditors. So which means from the trade creditor account, you can find out the raw material purchases, right? So the opening balance and the closing balance here and the cash payment here, and then the total purchases of raw materials is 145. And that 145 you should add here to the opening raw materials. And from that you have to minus the closing raw material, then you are getting the raw material consumption. And to that you have to add the direct labor costs. So here the direct labor cost is given straight away here, no adjustment for that. And then you are getting the prime cost. And to the prime cost, you have to add the production overheads. So here the production overhead is given directly to paid value. And for that, you have to add the machine depreciation as well. Because here, the machine is given as the carrying amount as in opening date and closing date. So the difference of that is your depreciation. Because in the additional information, it says there were no purchases or disposals of machinery. So the difference of carrying amount of the machines as in closing date and opening date, that is your current year depreciation. Right? So machine depreciation is 125. Then you are getting the production cost here, which means the manufacturing cost. Right? And then they ask you the cost of sale. And finding out the cost of sales, you have to adjust the finished stock. So opening finished stock plus production cost minus closing finished stock. Then you are getting the cost of sales. Right? So your cost of sales is 620. So these workings are not necessary if you have this draft in your mind, and then you can get the answers from your calculator. So always get used to use your calculator to get your answers, because there is very limited time that assigned for one question. So you have to keep going. If not, you can't finish up your paper within 2 hours. So that's the main thing, right? So always when you are practicing the papers, always do with your time period, time frame, right? Yes. Third, sorry, 13th one, they're asking from the standards. They're asking the correct statement as per Section 24 of the Partnership Ordinance Act. The partners are entitled to share the profit and losses equally. That's correct. The partners involved in the administration of the partnership are entitled to receive a remuneration. That's incorrect. In the ordinance, it says it's not entitled. If it is an agreement saying that the partner should pay the partner service, then you have to do the partner service appropriation. But in the Section 24 of the Partnership Ordinance, it's specially saying the partners are not entitled for partner salaries and loan interest, sorry, uh, capital interest as well. Partners are not entitled to receive an interest. Yes, that's correct. And the partners are entitled to be reimbursed if they have spent personal funds for the visa. That's also correct. So the correct answer should be fourth one. And then 14th and 15, they are given the capital account and current account opening balances and the profit that they are given, and then some other information as well. Then they're asking the effect of the partnership and the equity of the partnership in the end. So Anil and Banu are carrying out the partnership sharing profit and losses equally. As per the partnership agreement, each partner is entitled to an annual salary of 1,200. And the following opening balances are given here as well. And Anil and Banu contributed 600 and 400 as per the additional capital. And further, during the year, each partner has taken 1 million in cash as their drawings. And the profit share for each partner was 300. Right? So when they're asking the profit, uh, The profit that you found from the income statement of the partnership, then you are appropriating that profit through your appropriation account. So what are the ways of distributing profit is share of profit, but before that, interest on capital and partner salaries. So when they ask you the total profit of a partnership by giving these incomplete reports, you have to find out the profits by adding partner salaries, interest on capital, and share of profit. All those three. So here there is nothing for capital interest, but it says salaries for each partner is 1,200 per month, sorry, per year, and the share of profit for each 300. So altogether your total profit should be 3 million. And after that, from these information, they ask you the total equity. So the easiest way to find out the total equity is here is given the initial capital total, initial current total. To, uh, to those, you have to add the profit and then the additional capital, and then you have to minus the salaries reimbursed, which means the brokerage. Then you are getting the total equity as 14,400. And from 16 and 17, they are asking the question from uh, this case study. They're asking the profit for the year and the other components income and the total income and total expenses. So here, first of all, they are given the gross profit and other income, it says 1,600. But the case is, in computing the profit for the year ending, the revaluation surplus of motor vehicles, 1 million has been included in the other income. So to find out the net profit, you have to exclude that revaluation surplus in other income. So you are correct. The adjusted other income is 600, and there is some adjustment to do for other expense as well. So in here, the other expenses is given as how much? Ah, yeah. Other expense, you have to get the difference of what? Difference of um, difference of yeah. Here the profit for the year is given 4,200, and this 4,100 is include calculating 3,500 and 600. So 3,500 and other income 600, your total is 4,100, and the profit for the year is 2,200. So by excluding this 2,200 from the total of the gross profit and other income, you are generally getting the other expenses value. But for that other expenses, there is another adjustment to do there. What happened here? In computing the profit, yeah, the revaluation deficit of the machine 800 has been deducted entirely in computing the profit for the current year without considering the previous revaluation of the machinery, right? So there is a previously there is a 350 or what? There is a machine revaluation surplus is 450, right? But you recorded the total 800 revaluation deficit of the machine for this year in expenses without considering the previous revaluation. So that total 800 you should deduct here. And the revaluation surplus that you recorded in other income also you have to add that to here. So your other expenses is 2,100. And the machine revaluation deficit that the correct amount that you should record in other expenses is the total deficit is 800, but from that you have to deduct the revaluation surplus that you record, sorry, revaluation, yes, revaluation surplus that you recorded in the last year. So the machine revaluation net deficit is 350. Then you can find out the net profit as 1,650. And then they ask you the total comprehensive income. So the motor vehicle revaluation surplus 1 million. But from that you have to deduct the machine revaluation surplus written off 450. Then you are getting the total comprehensive income. Right? It's a bit difficult comparing to the other prediction that came in 2024. And then there must be the total income. So sales is the addition of the cost of sales and gross profit. Then you are getting the sales. And other income, we already deduct that 1 million, the revaluation surplus. So revaluation surpluses are not recorded under other income. So your correct other income is 600. And the motor vehicle revaluation surplus of this year is 1,000. So your total income should be 11,600. And total expenses, cost of sales given directly, and other expenses I already adjusted here. And your machine evaluation total deficit is 800. So your total expenses is 9,400. I think this is the hardest question in 2024 in the MCQs. Okay. 18th one, the following transaction has been occurred in Sachin PLC during the year ending 31st March 2024. And they are asking the net cash flow from investing activities. Purchasing a machine is an investing activity, and that is a cash outflow. And sold an office equipment with a carrying amount of 3,600 at a gain of 600. Then, which means you sold that office equipment for 4,800. Carrying amount plus the profit. Okay. And the third one, in the lease cases, the down payment and the direct payment that you are paying initially when you're getting a property based on lease, it should comes under investing activities, right? So your net cash flow is 1,800 a plus value. 19.1, which also following statements as per LKS 8. Accounting estimates arise due to the uncertainties inherent in business activities. That's correct. Accounting policies should always be selected by applying the guidelines prescribed in the accounting standards. That's incorrect. You can go with your management opinions as well. The effect of the accounting estimates should be adjusted to in the profit or loss of the current period and the future periods. Yes, that's correct. So changes of accounting estimates, we have to adjust for this year and then continue for the next years. But when you are correcting your errors, and if you can correct that errors for your past years, you should do that. Right? 20, which of the following statements are correct as per LKS 37? A provision is a liability of uncertain timing or amount. That's correct. A legal obligation is an obligation that derives from a country. That's correct. Le- legislation, right? Or other operations of law. An entity shall not recognize contingent liabilities and contingent assets. That's correct. The not recognized mean you are not doing a double entry for those. But you have to disclose contingent liabilities and contingent assets in a separate note. Okay. 21. Which of the following statements are as per SLFR 16? At the commencement date of the lease should measure the right of use asset at its fair value. That's incorrect. You are getting at the cost value, right? At the commencement date of the lease, the should measure the lease liability at the present value of the lease payment. That's correct. The present value of the lease payment is calculated using the interest rate implicit in the lease, which can be readily determined. That's also correct. So the correct answer should be fourth one. Information given for the retained earnings, and then they are asking the closing retained earnings balance. Stated owner share capital 7,500 and retained earnings opening balance is 3,500. It should mention in credit side in the retained earnings account, and the profit you have to transfer to the retained earnings, so which means you have to return credit to the retained earnings. And then what happened? Interim dividend payment. Interim dividend payment you have to debit to the retained earnings, and you capitalize retained earnings by issuing one share for every single share held on the date that opening date. So first of all, to find out the number of shares that you capitalize, you have to find out the existing shares. So the value of the existing shares is 7,500,000 and per share value is 100. So which means the number of shares over here is 75,000. Sorry, 750,000. And here you are capitalizing one share for every five shares. Oh no, my bad. Here the number of shares should be 7,500,000 divided by 100, 75,000. And 75,000 divided by 5, that is your number of shares at the capitalizing. And it should multiply by 120. Then the stated capital, which means the retained earnings capitalized 8,000, so 1,800. Then you can get the balance as 2,600 here. And 23rd one, the quick assets ratio of the business as at closing date is 1:1. The business is considering the following actions to improve its quick assets ratio. Quick assets mean what? Quick assets is how many quick assets there are to cover up your quick liabilities, current liabilities. So quick assets means from the current assets you are not getting the what you are not getting inventories and prepayments, right? To pay an insurance premium in advance. So when you are paying an insurance premium in advance, what happens? Your cash goes down, which means quick assets goes down. So quick ratio getting decreased. To sell existing inventory on credit, your debtors are increasing and stock decreasing. So when the debtors are increasing or quick assets are increasing, so which means ratio is also increasing here. To settle the existing short-term liabilities using cash in hand. So in this case, what happened? The both current liabilities and quick assets both are getting decreased, right? So then your quick assets ratio goes down. Last one, to sell existing inventory for cash. Then you are getting cash, which means your quick assets are increasing. So the ratio is also increasing. So the correct answer for question 23 is answer number 3. 24th one, which of the following activities can be considered as management function? Determine the cost of the product or service. Hmm, okay. Analyzing the behavior of cost when the activity level is changing, that's also management accounting function. Providing the financial information for the investors. No, it's a activity that falls under financial accounting. Analyzing the cost volume profit කියපු ගමන් it should be a management accounting function. 25th one, correct statements අහන්නේ. based on the inventory management in the firm. The economic order quantity of an inventory item is the reorder quantity at which the total of its annual ordering cost and annual holding cost is minimal. That's correct. The reorder level of the inventory item is calculated by multiplying the maximum consumption into maximum lead time. You are getting the reorder level. Cost formulas are used to measure the cost of the inventory item when specific identification method cannot be used. Even now, you have to use either FIFO method or VAT method to find out the closing stock, right? And the 26th one, the following information has been extracted from the payroll of a company and the additional information is given. Then they ask in the employee related expense. Basic salary plus allowances, your gross salary is 10,000. And to that, you have to add the employer contribution for EPF and ETF. The employee contribution for EPF is not an expense for the business, but the employer contribution. So, which means the contributions done by the business itself, it should consider as an expense, right? So, both EPF and ETF contributions done by the employer should comes here. So, your total expenses for employees is 11,800. And then they ask in the EPF payable value as in closing date. So at that point, you have to add EPF contribution done by the employee plus EPF contribution done by the employer. So both together, the total EPF payable here should be 4,500. In the 27th and 28th, they are asking from this information, cost of cost of production per unit. They are asking cost of production per unit. So in the production cost, there are two components, prime cost and production overhead. So here the prime cost are unit raw material and unit labor cost. It's a 2 kgs at 300, so which means 600, and 2 hours at 200, so which means 400. So your prime cost per unit is 1000, and production overhead absorption rate is 300 per direct labor hour, and there are 2 labor hours, so which means 600. Your unit production cost is 1600. And then they are asking the total fixed cost. What they are asking the total fixed cost at what activity level? 20,000 activity level. So here, production overhead per unit is 600. So which means your total production overhead at 20,000 units is 12,000. 12,000 means 12 million actually. And from that, the fixed cost is 50%. So the fixed production overhead here is 6 million. And it says 75% of non-production overheads are variable. So which means then the other amount, which means 25% of non-production overheads are fixed cost. Then you can find out the total fixed cost. Okay. And here the total production overhead 32,000, non-production overheads 8,000, then total cost is 40,000. Right? Because you got the unit production cost here and non-production overheads totally 8,000. So altogether your total cost is 40,000 for 20,000 units. So the cost per unit is then 40,000 divided by 20, 2,000. And unit selling price is they are adding 25% markup cost. So which means to find out sales price, you have to find out 125% based on your selling cost of the stock unit. So the unit selling price is 2,500, and then uh, unit variable cost is, from that you have to minus the fixed cost. Then you are finding out the unit variable cost, right? So your unit variable cost is 1,600. So unit selling price is 2,500. Unit variable cost is 1,600. Then you can find out the unit contribution as 900. Last two, in 29, they are asking the activity level of a manufacturing company is 1 million units, sorry, 100,000 units. The following information relates to the year ending closing date. Sales, total fixed cost, and profit is given here. They're asking the variable cost per unit and the break-even point, right? Sales 12 million. From that, you have to minus the profit. Then you are getting the total cost. From the total cost, after you deducting the fixed cost, you are getting the variable cost total. And that variable cost, you have to divide by the number of units. Then you are getting the unit variable cost, right? Then you can get the unit contribution here 50, and the fixed cost divided by unit contribution. Then you are getting the break-even point. So that's how to do from question number 1 to 30. The MCQ first 30 questions. So let's move for the other last 20 questions, which means in that point you have to write down the short answers. Okay. 31. Several activities of a firm are given below. A. Selection of appropriate accounting policies in preparing the general purpose financial statements. It falls under professional environment and assessment of tax liability in line with the previous provisions of the Internal Revenue Act. This falls under legal environment, use of the computerized accounting software, technological environment, and evaluation of buildings, considering the change in the market prices, economic fact, right? And then the 12th one's very easy. They are given the total assets and total liabilities for the opening date and closing date. And here it says the owner paid 50,000 to the credit of the business, and the owner obtained goods costing 1 million for his personal use. So then they are asking the stated impact plus or minus caused by the above two transactions with the value of the assets, liabilities, and equity of the business. So from the first one, what is happening? Owner is paying for the liabilities from his personal fund, so which means equity increasing and the liabilities decreasing. And then owner obtains the drawings, assets getting down and the equity was also getting down. Then they ask in the profit for the year. So the easiest way to find out the profit here is based on the accounting equation. Sorry, profit equation. So what is profit equation? Closing equity minus opening equity, and then from that you are getting the difference of the equity, and to that you have to add drawings and minus additional capital. So here, uh, first of all, you have to get the initial equity and the closing equity by deducting liabilities from their assets, and then the profit is 125,000. 33, what they're asking here, primary goods. Purchase timber on credit for 2,500,000 from Kasum. So here, this is a furniture manufacturing business. So purchasing timber, they are purchasing timber for what? For their production process. So it is a trade stock purchases. So that thing you have to record in purchase journal. B, purchase a timber processing machine on credit. So you are purchasing property, plant, and equipment on credit, and that should fall under general journal. C, sold furniture with a list price of 5,200,000 for cash, subject to a trade discount. So that falls under cash receipt journal. And settling back to the COSO, which means you are paying cash to the COSO. So that is cash payment journal. 34, write the journal entry to record the above transaction C and D. C, sold furniture with a list price. So keep in mind when the list price and the discount are given, so trade discounts are given, that trade discount you should deduct from the amount and then get the net value. But you are not recording double entries, so which means debit or credit for your trade discounts, right? So the double entry for that, for C, cash debit, yeah, cash debit 5 million and sales credit 5 million. And then you are settling back to the customer 2,500 with a discount receipt of 100. So creditors control totally you should debit and cash credit 2,400 and discount receipt also you should credit by 100. 35. State the type of account for each of the following general ledger accounts. So discount received is an income account. Drawings is an equity account, but drawings has a negative effect. So normally drawing equity account you should when the equity account increase it should credit. But in this case, drawings has a negative effect, but it is a liability, so it is a equity account. Provision for compensation is a liability account, and accumulated depreciation of machinery is an asset account. It also has a minus, which means the negative effect of the asset. 36. Complete the following statement with most appropriate accounting concept. Uh, Only the transaction with a monetary value, කිව්ව any money measurement concept, requires a firm to report all information, disclosure concept. Cost of goods purchased during the current year but yet not sold by the yearly matching concept, and the cost of relatively low value equipment with a useful life you consider as an expense instead of record as in asset. So the concept that effect into that is materiality concept. In the 37 one, they're asking the impact of these transactions for accumulated funds. So if it is an income, your accumulated fund should increase, and if it is an expense, accumulated fund should decrease, right? Subscription receivables, 20,000 was written off. So written off is an expense, right? So the impact for the accumulated fund, it should decrease, and the value is 20,000. And return of the sports ground, rented out the sports ground of 250,000 for cricket tournament held during the year and received 200,000 in cash in this respect. So it is an income renting your property. So the impact for the accumulated fund should increase and the effect should be 250,000, not 200,000. No? You have to record the income and expenses in accrual basis. So whether you received in cash or not, that doesn't matter. You have to record the total income and total expenses in accumulated fund, right? And 39, Amal and Bimal carried out a partnership without a written agreement. Chamara joined the partnership and investing 1 million and cash in land and works 2 million. So investing assets, the double entry should be cash account debit, land account debit, and Chamara's capital account should credit. And the goodwill on that date is 1,200,000. So they are not following the agreement, so which means you have to uh, distribute profit equally. So simply mean your profit sharing ratio is equal 1 to 1 and 1 to 1 to 1. So when you're adjusting goodwill, always you should debit goodwill based on your new ratio. And your new ratio for Amal, Bimal, and Chamar is 1 to 1 to 1. And then you have to credit for your old ratio. In old ratio is 1 to 1, right? Yes, so that's how you are recording the goodwill. Complete the following statement as per the conceptual framework for the financial reporting. The equity is owner's interest, the assets of the entity after deducting all its liabilities. The liability is a present obligation to transfer and economic resources as a result of past events. Income is increase in assets and decrease in liabilities. Very easy, right? Uh, as per inventories are measured at a cost and NRV, whichever is lower, that's correct. NRV is estimated selling price in the ordinary cost of business, less the estimated cost, correct? And entities should use the same cost formula for all inventories, correct? Out of the first in, first out and WAC method, the one that gives the low aim that's incorrect. And here, the financial statement of Saman PLC for the year ending 31st March 2024 was given, authorized for issue by the directors on 30th June. The following events took place in the company after 31st March 2024. And then is what they ask him. Non-adjusting events indicate only the number. So what are the non-adjusting? The case was filed in the middle of the year by a customer against the company demanding a compensation of 15 million. The court order was given on June 15 before authorizing the financial statement to pay his compensation. So this thing you have to adjust. Yes, right? This thing you have to adjust because yes. We didn't adjust this. Yeah, this case was filed on after the closing date, right? Then you are not adjusting this. It's not middle of the year, so that's my bad. I saw that 2024, October 4th. No, it's 2024, April 10th, after the financial year. So that is not adjusting. If actually the carrying amount of 9 million destroyed on fire, not adjusting. The data is declared as bankrupt, as in closing date 3 million. That should be adjusted. So from the asset, it should minus 3 million. And here the non-adjusting events are number one and number two. And the effect for the total assets and total liabilities, because here you are adjusting only the transaction number three. And from that transaction number three, when you are adjusting, the double entry should be debit and data is credit. So when the data is credit, what happens to the assets? It's getting down, getting decreased. Right? So your adjusted assets are 57 million. For liabilities, there is nothing to change. So it's still 25 million. 43, the two PLC purchased a machine for 6 million on 1st of April 2021 and estimated its useful life as 5 years. The company depreciated the machines on reducing balance method at 40% per annum. On 1st of April 2023, the company revised the depreciation method of the machine to straight line method and the residual value estimated blah blah blah. They ask you the depreciation expense for the year ending 31st March 2022, and that should be 2,400. 6 million into 40%. And here you are doing the depreciation based on reducing balance method. So to find out the depreciation for next year, you have to get the carrying amount. The carrying amount you should multiply by 40%. So in the next year, the depreciation is 1,440. So up to 2023 closing day, the accumulated depreciation is 3,804. Now you are revising the depreciation method. So as at that point, the carrying amount of that machine is 6 million cost and the accumulated depreciation is 2,160. And now the remaining useful life is 3 years, right? Then you can get the depreciation by dividing the carrying amount from the remaining useful life. An entry should recognize revenue when it's satisfying the performance obligation by providing a promised goods. Yes, that's correct. The transaction price is the amount of consideration that the entity has received in cash in exchange of goods or services. Has received in cash නෙවෙයි promise වෙච්ච amount එක නෙවෙයි cash වලින් ලැබුණ නැතනේ අපි income එක identify කරගන්නේ. So that's false. The consideration promised in the contract may include fixed amounts, variable amounts, or both. That's correct. The performance obligations can be satisfied at the point in a time or over period of time. That's also correct. Chapter 5, dividends per share, profit after share, after tax and interest coverage ratio they're asking. To find out the dividend per share, it says the distributed dividends 300,000 and the number of shares is 60,000, then dividend per share is 5 rupees. And the profits, it says the earnings per share is 30. And 30 multiplied by number of shares, then you are getting the total profit. And interest coverage ratio means profit plus interest plus tax divided by interest. So here the profit you find from here 1800 and the interest is given 500 and the tax is given 700 altogether divided by 5. So your interest coverage ratio is 6 times. The following cost items relate to the firm which assembles bicycles. Cost of plans and tubes, direct and variable. Monthly wages of assembly wages. They are given the monthly wages. So it falls under direct, but it's fixed. Monthly salary of the assembly division supervisor is indirect and fixed. Cost of grease and oil, indirect and uh, variable. Other cost variable, it's also can considered as fixed, right? 47. The cost that can be identified specifically with the cost object is known as overheads, indirect. Stores ledger records both quantity and value. That's correct. Fixed overheads do not change due to the increase or decrease in the production level with the relevant range. Correct. Wages paid to machine operators on an output basis are classified as direct labor cost. That's also correct. In 48, they are given the information about production overheads. There are two cost centers and overhead absorption per unit is given, and then the labor hours and machine hours. Then to find out the absorption rate per hour, then you have to divide that. Then you are getting the absorption rate per hour, and then total hours and multiply by cost centers. Sorry, absorption rate per unit by number of so that absorption rate per hour by number of hours, then you are getting the total production overhead. So 49 and 50, the last slide of this video. Jaya PLC is planning to produce a single product. The estimated actual level of the company is 18,000 units. The company's expected break-even point is 10,000 units. The expected selling price is 80 per unit and the contribution to sales ratio is 15%. So the margin is, which means the difference between sales and selling price and variable cost. Sorry, my bad. Selling price and the contribution to sales ratio. The other part is the variable cost based on the sales, right? So the variable cost is that amount. And then the total fixed cost, the break-even point is given here straight away. So how to find the break-even point? Fixed cost divided by contribution margin, right? The answer is fixed cost. Okay, valid. Break-even point, contribute, not contribution margin, contribution. Then here in this case, you know the contribution and then you know the break-even point. So your fixed cost is 200,000. Good. And the profit at the actual level of 15,000 units. To find out 15,000, the ACS is to get the total contribution minus total fixed cost, then you are getting the profit. And then the payback period, accounting rate of return, and the average profit and average investment. Uh, A firm is considered to purchase an eco-friendly machine for cost of 5 million. The useful life and the residual value of this machine are estimated as 10 years and 400,000 respectively. This machine is depreciated on straight-line method respective of net cash inflow. And this machine is 624. So payback period. The expected net cash flow is given in average value. So the initial investment divided by the cash flow of the each year, the average value, then you are there will be payback period at 8 years. To find out the accounted rate of return, average profit, the difference between cash flow and the average profit, the profit is depreciation. So here the cash flow is given. So from that cash flow, you have to find out the profit. So which means you have to find out the depreciation, and the depreciation is minus from the cash flow. Then you are getting the profits. And the average investment means initial investment plus disposal value divided by 2, and then you can get the average investment as well. So comparing to the last year, actually the 2024 first paper is much easy. So I predict I predict I predict yes I am thinking that the 2025 might be harder than this. Okay, so get ready for that, and do share with this video with your friends as I have for me, and do comment if you are if you want to ask for anything, just give a comment or contact me through WhatsApp. So let's meet some other exercise. So clear video. Until that, goodbye. Enjoy everyone. Do well and do practice for your ILOs. Bye.